Good day, everyone. This is Navarro Nicolette, and my topic is all about domestic financial sectors, depository institution, and bank service. Domestic financial sectors. The financial sectors include enterprises that the regulators that provide the framework for facilitating lending and borrowing. We can classify these enterprises into different sectors depending on the type of transactions they facilitate. Domestic financial sector plays an important role in the functioning of the economy through intermediation. Domestic financial sector acts as a bridge between savers and borrowers, taking funds from the savers, for example, through deposits, and lending them to those who want to borrow, whether they are individuals, businesses, or governments. Depository financial institution can be an organization, bank, or institution that holds securities and assets in the trading of securities. So, a depository provides a security and liquidity in the market. It uses money deposited for safekeeping to lend to others, invest in the other securities, and offers a funds transfer system. Non-depository financial institution can spread the financial risks of individuals over a large group or provide investment services for greater returns or for a future income. Non-depository institutions include insurance companies, pension funds, securities firms, government-sponsored enterprises, and finance companies. Insurance is a financial safety net, helping you and your loved ones recover after something bad happens, such as a fire, thief, lawsuit, or a car accident. When you purchase insurance, you'll receive an insurance policy, which is a legal contract between you and your insurance provider. So, the purpose of an investment company is to hold and manage securities for investment purposes, but they offer investors a wide range of funds and investment services, such as portfolio management, record keeping, custodial, legal, accounting, and tax management. Depository institutions include commercial banks and thrips. Thrips include savings, loans associations, saving banks, and credit unions. As the name indicates, these entities accept deposits that they represent the liabilities of the deposit accepting institutions. With the funds raised through deposit and non-deposit sources obtained by issuing debt obligation in the financial market, depository institutions make loans to various entities like businesses, consumers, state, and local governments. So, a bank, organization, or any institution holding and assisting in security trading is referred to as a depository institution. So, depository institution holds securities in the same way that bank accounts hold funds. A depository can also be a place where something is held for safekeeping or storage. Commercial banks are the largest type of depository institution and will be the focus here. A commercial bank is a financial institution that is owned by shareholders and engages in accepting deposits and lending for a profit. A bank may be owned by a bank holding company, BHC, which is a company that owns one or more banks. So, a commercial bank is a financial institution that provides services like loans, certificates of deposits, savings bank accounts, bank overdrafts, etc. to its customers. These institutions make money by lending loans to individuals and earning interest on loans. And the most important function of a commercial bank is to collect deposits from the public and lend those deposits for the development of business, agriculture,
trade, and commerce. We have here bank services. So the principal services provided by commercial banks are individual banking, institutional banking, and global banking. So individual banking, it includes consumer lending, residential mortgage lending, consumer installment loans, credit card financing, automobile and boat financing, brokerage services, student loans, and individual-oriented financial investment services such as personal trust and investment services. Institutional banking, it includes loans to both non-financial and financial business government entities, state and local governments in the United States and the foreign governments, commercial real estates, financing and leasing activities. So, institutional banking is about working with a customer to develop a bespoke banking solution. These could include anything from debt structuring and funding solution to funds management and trading and research services. In global banking, commercial banks compete head to head with another type of financial institution, investment banking companies. In the global arena, banks engage in corporate financing that involves procuring of funds for a bank's customers, which can go beyond traditional bank loans to involve the underwriting of securities and providing letters of credit and other types of guarantees. And financial advice on such matters as strategies for obtaining funds, corporate restructuring, divestitures, and acquisitions. So, global banking provides financial services and products to corporates, governments, and institutions worldwide. Bank funding. Banks are highly leveraged financial institutions, meaning that most of their funds come from borrowing. One form of borrowing includes deposits. There are four types of deposit accounts issued by banks. First is the demand deposits. Second is the savings deposits. Third is the time deposits and money market demand accounts. So, we have here the demand deposits. Demand deposits, more popularly known as checking accounts. It can be withdrawn upon demand and offer a minimal interest. So, demand deposits is important in consumer spending as they hold the funds used to pay for everyday expenses. So, for example, the expenses may be include groceries, transportation costs, personal care items, and more. Next is the savings deposits. Savings deposits pay interest, typically below market interest rates, do not have a specific maturity, and usually can be withdrawn upon demand. So, savings deposits is the type of bank account which is opened by the people in order to save a part of their income. Lastly is the time deposit. Time deposits is more popularly referred to as certificates of deposit or CDS, have a fixed maturity date and pay either a fixed or floating interest rate. A money market demand account pays interest based on short-term interest rates. So, a time deposits are highly secured investment accounts that allow your money to grow at a reliable interest rate. And that would be all for my report. Thank you and good day.